I'm going to change gears and connect with Neelkanth Mishra to talk about the three most important aspects which investors should focus on. Post the election verdict, what changes at the macro level, which is fiscal deficit, real estate cycle, what changes there? Second, what changes at the earnings level for the India, for companies, and then see what changes at a perception level, which is P multiple. I guess these are three things which we need to address, Mishra ji. किससे चालू करें?
We have to be
किनसे चालू करें?
नहीं तो वहीं से शुरू करते हैं. To keep a stable head and assess what the market may be looking at, say even 1 week from now, we'll be thinking about whether the monsoon has hit Bombay or not. I mean, whether the rest of the country gets a good monsoon or not. If there are less water cuts in Bombay, I'm sure the markets will, I mean, the people who trade the markets here will feel more comfortable that the monsoons are on track and therefore the economy is going to be fine. Those are the kind of things that will start affecting markets in a couple of weeks. And therefore, we need to be very sort of balanced about approaching it. So let's start with the macro. I think, as you said, the real estate cycle is what is driving the economy. Nothing changes, right? People are not. In fact, if you look at the percentage vote share of the winning alliance, this is the second highest we have seen in 35 years. So I don't think there is any reason to worry that the number of people, percentage of people who voted for the winning alliance has dropped very sharply. It is the second highest because after 2019. The real estate cycle, I think, is when it turns, it turns. People don't change their opinions on whether they should be buying houses or not. So the underlying economy, I think, is going to be fine. Is there a need to recalibrate the government's fiscal stance? Frankly, as important as the verdict itself is how it is interpreted by the party that has to take decisions. Now, in 2004, when there was a change of regime, the finance minister in his July speech said the government of India cannot continue to work the way it did. They interpreted the verdict as a negation of the NDA government's policies and tried to become pro-poor. And that reflected in their policies thereafter. Here, given that while UP and Maharashtra was where the BJP and the NDA faced some negative surprises, in Madhya Pradesh, in Bihar, in Uttarakhand, in Himachal, Gujarat, in Odisha, they did not. And therefore, it would be wrong to, I think, ascribe the reversals to the poor somehow sort of ganging up and voting out, trying to vote out the BJP. It could be other factors, candidate selection. It could be, particular communities not voting in favor of the BJP. So I don't expect the fiscal stance to change. In fact, with the RBI dividend being significantly better than what was budgeted, I wouldn't be surprised if in the July budget, the government chooses to bring down its FY25 fiscal deficit target from 5.1% to 4.9%. Because that money is there. I mean, 1.25 trillion rupees of extra money. So I don't see the macro, at least in the near term, changing very meaningfully. The medium to long term growth, yes, I think there are tough decisions that could have been taken with a much stronger mandate. For example, how to better fund urban infrastructure or how to restructure the government, given that the whole world is getting back to industrial policy. And we need to have a much more agile government aligned to how the future industry in the world is going to shape up. And some of those more radical changes may be harder to do now. But from the perspective of the market, I think it's the next 3 to 5 years of growth, which I don't think gets affected meaningfully because of what has happened yesterday.
Second is that ultimately, Mr. Mishra, market price is a function of EPS into PE. We have addressed the first part, which is the earnings, the macro. What about the perception part? India was enjoying a premium because of political stability. India was enjoying a premium because of pace of reforms. India was enjoying a premium because of local money. So what about the second part? How do you see that changing?
I don't understand why there are questions on stability. I mean, we have seen, other than the 96 to 98 period, where remember that it was a very different political environment. There was the Congress was shrinking, and regional parties were rising, and there was complete lack of understanding on what the popular mandate was, and there were 4 prime ministers in 2 years, 3 years. This is a very different scenario. So even with the 2004 and the 2009 governments, the leading party had far fewer seats, and this time we have the leading party with 240 seats. So I don't see any reason why we should doubt the ability to last the full term, and there is no reason why even the alliance partners, and frankly, at least the major alliance partners that they need to cross the 272 number, are generally responsible. I mean, there is one partner who, at least in the state level, has changed opinion several times, but it is all because of the ambitions at the state level. I don't think there is, with 13 seats, it's going to be possible for him to really disrupt the functioning of the central government. So there could be some economic ministries, which of course will be handed over to the alliance partners, the coalition partners. And again, it would be unwise to expect that anyone who sits in that ministry is going to do a bad job. So there will be some recalibration of how the government works, but there is no reason to expect that it won't be a stable government. There is no reason to expect that any of the major ministries like finance, defense, external affairs, home will need to be given up to a coalition partner. Because frankly, the largest party is at 240, the next biggest is 16. So, and as much as yesterday there was a speculation about XYZ partner trying to switch over to the other side, guess what? The largest political party, as per parliamentary protocol, will be invited to form the government. And if the parties on this side are open to solicitation from the other side, the reverse can be true as well. So one should not overemphasize the bargaining power that some of the smaller parties may have. They're all responsible. I think they're very adept politicians, and their focus will be on maximizing the gains within their respective states. So I don't expect any instability in the government. I don't expect that the policy stance at the legislative level and an executive level is going to be meaningfully different. The exit poll verdicts had I think, opened up the possibility of constitutional amendments, because if you get 2/3 majority at 400, they would have actually got 2/3 majority in the combined House of Parliament. Those kind of possibilities now are ruled out. So, but we should see, a stable government with legislative authority, a lot of executive authority. I don't see why it should not be par for the course, or basically continuation of what we saw in the last 10 years.
The foreign investor, positioning as well. While sure enough, it's a given that India's premium is high as opposed to other EMs. But now with this event out of the way, you think it'll bring them back to India?
I think we tend to treat foreign investors like some finicky, or a very, very temperamental individual. See, the fact is, India's GDP growth remains intact. The fiscal consolidation path remains intact. The cost of funding continues to fall. The fact that many of the reforms undertaken in the last 3-4 years will continue to drive the economy over the next couple of years. Those are the factors that are going to drive FII behavior. Whether the winning party in the Lok Sabha has 280 seats or 240 seats, you really think it's important enough for some sensible person to change their opinions on India? I don't think so. But at the same time, we have to remember that the foreign investor, one, is less important now. It is the domestic investor, what I call the unintended pools of capital, the flows coming in through SIPs, through EPFO, through mandatory allocations of insurance money. Those trends, I don't think, are going to change at all. And for FIIs themselves, we've been putting out research over the last several years, and we've updated that just 2 months back. that less than 10% of FII ownership in India is through India dedicated funds. A large part is allocations through EM fund, through Asia fund, through global funds. And so the bulk of the volatility that we see in FII flows into India are resulting from volatility of flows into EM funds, into Asia funds, into global funds. So we should not ascribe too much of volition, too much of, I would say, agency to active fund managers. Most people, if the benchmark is 20%, will have 22% on India or 18% on India. I mean, there are very, very few. It's a classic bell curve. There will be very few who are at 30% or at 5%. And so that's how it works. So I think the volatility of FII flow is also driven by expectations of US rates, expectations of what's happening to other emerging markets. We should not overemphasize the role of elections in deciding what FII is going to do.
Just taking a look at our screens today, and one can't help but notice that it's that cluster of FMCG stocks that are standing tall. Just wondering what exactly the tilt or the focus should be towards this defensive bent in the portfolio. What is it that you would advise at a time like this?
Well, I expect the economic trends to continue the way they were. And what the market is now tilting towards is a slightly more profligate fiscal stance by the government. I can see other broker reports and in fact, investor commentary that I get. I mean, everything changes because the BJP lost 60 seats and something has to change. And therefore, what has to change is the fiscal stance. It's a classic behavior of a person with a hammer who sees everything as a nail. That, these are not the only reasons why the BJP did badly in UP and Maharashtra. I mean, that could be one of the contributing factors. But is the solution to that also fiscal profligacy? And I don't think that is the way these will be implemented or it will be interpreted. So I think the market's reaction has been that, look, there is going to be volatility. Staples as a sector had done very badly on a relative basis. So there is a mean reversal trend. There was, in fact, even before the elections, some improvement in the volume growth for some of these firms. So that is, of course, supportive. And then we top that up with expectation that the reaction of the government to this verdict is going to be more fiscal profligacy. And then it makes sense to switch from industrials to FMCG. The first two arguments I am supportive of. In fact, we also were somewhat positive in our model portfolio on consumers, despite knowing that the volume growth will remain muted, because we thought that industrials were overpriced and that consumption, as the economy recovered, the overall slack in the labor market would ease and we would see a slightly better environment for consumer companies. But I'm totally in disagreement with this expectation of a change of fiscal stance by the government, because I don't expect it to happen.
Spoke to you last time, you said that personally you were of the view that Indian bonds were more attractive than equities, but after that a correction has come in. Would you still maintain that same view?
Oh, absolutely. So I think that, if the FY24 fiscal deficit target fiscal deficit was below the revised estimate of 5.8, it came to 5.6. Remember that the government did 80 basis points of fiscal consolidation in 1 year. Now on that base, 5.1 looks fairly easy. In fact, I think 4.9 is very possible. Remember that the US 10-year bond yields are now correcting because the economy is weakening. And so in that environment, I think the likelihood of the Fed easing, slowing down QT, accelerating QE, and then a lot of foreign buyers finding Indian bonds very attractive, because remember that the fully accessible route bonds, the FAR bonds, are where the foreigners can freely buy, are $250 to $300 billion outstanding. And therefore, the likelihood of bond yields falling from here, in fact, the likelihood of the government being able to achieve a 4.5% target in FY26 is now much higher than it was 3 months back. So I still think that the bonds are much more attractive. Equities, I don't expect a very sharp fall from here, given that fundamentals in the economy are still quite decent. But they are expensive. And I've been expecting time correction. I think market isn't better than that, but so far. But I expect time correction to occur over the next 12 months.
Neelkanth, really appreciate your time. I know it's a busy morning for you. Must be getting a lot of client calls, but you've still managed to find time. Really appreciate that.
If you like this video, then like, share and subscribe to ET Now.